Okay, so let's talk about some 7-2 stuff. We've got 2 quizzes we're working on that we extended the deadline to. And let's look at mix and yield. We'll make sure we do at least a mix and a yield question. Okay. And open answer, I'm guessing, would be the preferred way. Or is there, yeah?
Can we try one of the, it's an open answer yield variance?
Mm.
One of the senior labor.
Like this one right here?
Yeah.
All right, let's do this one. Okay, so firm has 2 labor inputs, senior and junior laborer. The standard mix is 1 senior laborer per hour. One senior laborer hour per 3 junior laborer hours. 4 total hours is the standard hour of input for a single finished goods unit. All right, so every finished goods unit is going to take 4 hours of work, 1 senior laborer, 3 hours of junior labor work. Senior laborers cost $23.37 per hour, and junior laborers cost $11.79 per hour. The firm has actually completed 10,839 finished goods units, which is our actual yield, and used 38,453 total labor hours. What is the firm's yield variance? So we're asking for yield variance at the end of the day, and that's actual yield minus standard yield all times this standard price, which is standard price at standard mix. Okay, so that's why that first paragraph is important, is to figure out what the standard price at standard mix is. And the second paragraph, just one sentence here, this right here, gives us actual yield and gives us information necessary to figure out what the standard yield would be. So those are all 3 points of the equation, all 3 variables in the equation right there. So let's go ahead and calculate that out. All right, open answer yield question. Okay, let's build the table here. We have senior. Let's build a table to get the standard price. Junior laborer, and we need 1 hour of senior laborer and 3 hours of junior laborer for each finished goods unit. And $23.37 is the cost per hour of the senior laborer. $11.79 is the cost per hour of the junior laborer. So we can multiply those across. So for every finished goods units, we're incurring $23.37 of senior laborer time, and $35.37 of junior laborer time. So the sum of that per finished goods unit is going to be our standard price at standard mix. Great, that's one of the variables. Good. And the question gives us the second variable, that's our actual yield. And it tells us that we completed 38,453 complete is the wrong word. We used 38,453 total labor hours, which is the input we're talking about. And so if we have 4, which is from up here, 4 total hours is the standard hours of input for a single finished goods unit. That's our standard, I'll put it this way, standard input quantity, input units, how about that? And the idea is then, given that number of labor hours divided by the number of labor hours there should be per finished goods unit, our standard yield should be $9,613.25, not dollars. Not dollars, it's units, finished goods units. Okay, so this is going to be a favorable yield, even though we're not used to that. We're used to, if actual is greater than the standard, whatever the lever is we're pulling, then that's bad. In this case, we're talking about, we've flipped it around, we're holding constant the input and letting the yield move. And so yeah, if I put in $5 or 5 labor hours or 5 puppies, whatever the input is, and I get more yield out of it, that's a good thing than expected. And so this is the sign rule that you've learned for every other variance so far is flipped with the yield variance. So this is going to actually be a favorable variance. Yeah. So I'm just going to do that in the cell. Actual yield minus standard yield, all times our standard price at standard mix. So that should be our answer for this question right here. And we can round it to cents. Does look okay? Yeah. Okay, let's try a mix variance question, see if we find a open answer one. That's what I want to do. I kind of want to do this one actually. There's a reason this particular one comes up. I like this one in particular because we'll talk about it in a minute. All right, so this is a mix MCQ question, multiple choice question. That's what it stands for. All right, so we have two substitutable inputs, chemical A and chemical B, and we typically use 12 to 8, A to B. All right, so that's 12, 8, A to B, total. This is all our standard stuff. I'll leave that there, but I guess we're going to move into build a table. That's what we are going to end up doing, so let's just start that from the beginning. All right, so we have our prices here, and in mixed questions, we can ignore those bullet points. We know immediately. We've got I'll build it so it's the right direction for you. We've got our mountain range here, either the 2 mountain ranges or the 3 peak mountain range, where you're looking at price variance between actual and quasi-budget, quantity variance between quasi-budget and flexible budget, flexible budget, and then volume variance between flexible budget and static budget. And yield and mix variances are taking the quasi-budget and flexible budget quantity variance business here and just breaking that quantity variance into 2. The yield, which operates similar to a standard quantity variance, except it is flipped around and now talking about finished goods yields per quantity instead of quantity for fixed yield, and mix variance, which talks about, well, how much did it cost us extra because we messed up the mix of substitutable inputs. Okay, so that's the quantity variance area. We're at standard price throughout there. Not till we get over on this mountain right here, where we're talking about any sort of price lever we're pulling to get to actual price over here. Okay, so there's no reason we're ever going to use an actual price when we're doing a mixed variance. It's a derivative of the quantity variance, and quantity variances are all at standard price. So always ignore the actual prices. It's one trap you can overcome. All right, and then during this period from actually use 11,000 gallons of chemical A, 9,000 gallons of chemical B, producing 20,000 gallons of finished goods. All right, so now I'm going to build my table, which is total actual input, which is 20,000. You put it on we put it on both lines here. And here's where I'm going to start using the mixes. So we have actual mix on the right here, and that is, no, I need to put it equals 11,000 divided by that total, 55%. That's 11,000 gallons of chemical A right here. And we have 9,000 gallons of chemical B divided by the total right here. Okay, now 40 and 50 is our standard price. And we're always using that. Multiply across. This is called the subtotal. And we can copy that over and change this to standard mix. Now the standard mix is, I can code it in since I put it in Excel. It's A over the total and B over the total. Okay, so we clearly used less chemical A than expected and more chemical B than expected. And chemical A is the cheap one. So we overused relatively chemical B, the expensive one. So this is going to be an unfavorable variance, whatever it ends up being. It's 10,000 unfavorable. Actual costs, because we had a heavy hand with the chemical B in the mixture, and it's the more expensive of the two. $10,000 of unfavorable variance there. Okay. All right. Should we look at the overhead quiz? We're going to look at the overhead quiz. I guess I don't know why I asked you. I guess what I should ask is, which particular variances do you want to go over in the overhead variance section here? And there are four possible ones. We have a quantity and a price for variable overhead, and we have a spending and a volume for fixed overhead. One of each. Yeah? Okay, well, we can do that. All right. Well, we got three of them in open answer form. So let's go with that. All right, so here we have Thrawn Strategic Solutions, a firm that uses a predetermined overhead rate, PDOH rate, to allocate overhead. The firm incurs variable and fixed overhead. The firm's PDOH for the period is $15 per cost driver unit, and 47% of that PDOH is for variable overhead costs. The remainder of the PDOH is for fixed costs. During the period, Thrawn Strategic Solutions actually incurred $29,100 in fixed overhead costs. The firm budgeted 2,026 units of cost driver consumption, but 1,504 units of cost driver were actually consumed. So we can use one of two formulas here. We have two formulas for each one of these variances, right? One which is more algebraic, where it's using the parentheses, and then the difference in the parentheses multiplied by some price or some quantity on the outside. Or we can use the box method, which says this times this minus this times this. And what I like about that second method is for problems like this, where we know the total actual costs. That's one of those boxes, this times this. That's full actuals. With typical mountain range, price, quantity, volume variance, static budget, flexible budget, quasi-budget, actuals, with fixed overhead, these are largely irrelevant or wouldn't be worth caring about. We have spending variance as the difference between actuals and the static budget. And I'm saying I gave you $29,100 as the actuals here. If we can just pretty nice and easily figure out static budget amount of fixed overhead, then we have a spending variance pretty quickly for this one, since that's what it's asking for. So, FOH spending variance, open answer question. We know we have 2,900 actual fixed overhead. And we know that we budgeted this amount of cost driver consumption. So at static budget, we would have budgeted that amount times whatever cost per cost driver unit we assume fixed overhead incurs. So that's going to give us our static budget. So we have 2,026 budgeted. It's called standard quantity. That's what that is. The names have changed, but it equals the same thing. It's the same function there. And we can take this PDOH and figure out how much of it is the PDFOH, predetermined fixed overhead rate. So we have $15 is our PDOH. 47% is our variable portion of the PDOH. And so that 15 times 1 minus that amount, or 53%, we're just getting 53% because 53% must be the fixed overhead amount based on this parenthetical right here. If 47% is the variable, then the remaining 53% is the fixed. And so mathematically, we're just doing 1 minus 47% to get the PDFOH, which is our standard price. So multiply the standard quantity by the standard price, and we end up with the static budget FOH. Subtract those two. That has to be the spending variance. Okay, anybody see a mistake anywhere? I think I've got it. Yeah. Yeah, I took the overall PDOH and multiply it by whatever percent is left over for the fixed overhead portion. Yeah, 1 minus that, the variable percent, yeah. Okay, was that what you wanted to? Yeah. Okay. All right, 1 out of 4. Fixed overhead volume variance. And this is where the fixed overhead does the weird thing where now we're going to go to applied costs and get volume variance. And I recognized, speaking with a student the other day, recognized that I think my diagram is it accurate in one aspect in the textbook. This really is an actual quantity times standard price, which usually is what we have right here in the quasi-budget. But in the context of a fixed overhead, that actually, using actual quantity times standard price actually makes it more fictitious because of the contrived nature of PDOH applying fixed overhead based on a volume-related cost driver. Fixed overhead is fixed. We know already it's not going to move up and down with volume. And so this applied cost really is like a quasi-budget, but we're pushing it over here because it's more hypothetical than even the static budget. We wouldn't ever budget this amount because we wouldn't have assumed that it would move up and down with cost driver consumptions, fixed overhead cost. I think in the diagram, which I'll have to fix, it says budgeted quantity asterisk. And I think when I wrote it, I had some rationale for how it's actually a budget. I don't know exactly how I had the rationale for it. But anyway, the point is, that's our volume variance. And so we can now ignore the actual right here, because this question setup, the fact pattern here has the same setup as the previous question. We're just going to ignore different pieces of it for the volume variance question. We can ignore this one. We don't care about the actuals at all. We're doing volume variance, so we're doing static budget minus the applied cost. And in this case, I actually want to use the more algebraic method. FOH spending variance equals actual cost minus static budget cost. Let's put that in quickly to summarize what we said. Whereas down here in the volume variance open answer question, fixed overhead volume variance equals, in this case, we're going to do the standard quantity minus the actual quantity times the standard price. So I put those words in there, and I'm going to map them to the different pieces in the question. So we have a standard quantity, what we budgeted, $24.45 of cost driver, and an actual quantity, $18.50. And then we can, from this sentence right here, derive the PDFOH, which is our standard price. Okay, we're using With overhead, we've changed the words, but they still are in the end a standard quantity, an actual quantity, a standard price, and an actual price. So I'm just putting those words in. All right, so our actual quantity is 1850. Our standard quantity, 24.45. And our standard price, PDOH, is 15.75, right up here. Our variable portion, let's grab this, is 0.54, 54%. And so with the same equation as before, our PDOH times the fixed portion, which is 100% minus the percent, that's the variable portion, gives us our PDFOH, or the standard price. So now I'm going to put standard quantity minus actual quantity times the PDFOH. So that should be our volume variance. Yep. Okay.
So is that favorable?
No, it's going to be an unfavorable one. So yeah, because it's positive. So the idea is we have this really contrived number that was really low because we didn't actually incur that many cost driver. So not much of our fixed overhead was pushed on to, was applied, or not as much as we expected. And when we move to the more real number of what we actually would have budgeted if we were using our brains with it, applying the assumption of fixed being fixed, the price went up. The cost went up, basically, is the idea. With that logic, anyway, I see how it's favorable. It's also positive, and so it's favorable. Sorry, unfavorable. That's using that logic is why it's unfavorable, and also it's positive, so it's unfavorable. All right, scoot on over to the variable overhead. We have one open answer in this question. We have the quantity variance open answer question. And they're set up very similarly. All right, so Palpatine Climbing Gear is a firm that uses PDOH. Firm incurs variable and fixed overhead. The firm's PDOH is 1849, 49% of which is variable. Okay, great. That's going to be we can get our standard price by multiplying 1849 by 49%. Because now we're not worried about the fixed portion, which is the remainder after the variable portion. So it's not 1 minus 49%. Now it's just 49%. 1849 times 49%. That's going to be our standard price. During the period, Palpatine Climbing Gear actually incurred $15,329 in variable overhead costs. The firm's static budget expects 2315 units of cost driver consumed, but 3483 units of cost driver were actually consumed to produce 543 finished goods units. The firm has a standard of 2.4 cost driver units per finished goods unit. All right, so I did a little tricky business here for you, and I gave you a number that you need to ignore. So variable overhead uses the much more the traditional mountain range, or it uses, yes, exactly, the traditional mountain range here. Not the weird fixed overhead mountain range, but we're looking for a quantity variance here, and so we want to know the quasi-budget number and the flexible budget number. We don't need to know the static budget number, and so when it says 2315 units were expected on the static budget, right here, from static budget, that's going to be irrelevant to us. We don't care how much they were expecting on the static budget. If we use that number in our calculations, we're going to get a quantity variance that bridges here to here, which is really a quantity variance plus a volume variance. That'll be the wrong answer, and it's not as usable if we were actually doing this for the firm. We get the wrong answer for what we need to change, if anything. So we can ignore the 2315. Also, because it's a quantity variance here, We don't need to know what the actual amount was. We're worried about these two numbers. So we're looking at these right here. So our actual volume, actual production right here, produce 543 finished goods units. So our actual volume is 543. And we have a standard of 2.4 cost driver units per finished goods unit. So we can derive from that what we would have budgeted, what the standard quantity would be of cost driver units given that actual volume of 543. That's the flexible budget number. That's the standard quantity for the flexible budget. So let's go here. VOH, quant variance, open answer. Let's copy down some things for the standard price. Just copying down the information in this sentence right here. And I can multiply those two. That's our PDVOH, predetermined variable overhead rate, which is also serving as our standard price for variable overhead variances. All right. Now I don't think I did, but maybe I did say that we can ignore the 483. I was incorrect if I said that. I know I said for sure we can ignore that one. And I may have accidentally highlighted all the way till here, which implied also ignoring that. But that's the actual quantity, so we can't ignore that. Trying to fill out our equation. A quantity variance, like we've known for weeks now, is actual quantity minus standard quantity, all times standard price. Have our standard price, great. We can copy over actual quantity, 3483. Question is simply standard quantity left. Repeat one more time. We're tempted to follow this, take this number right here and use it. That would be wrong, again, for the same reasons as we said before. Instead, we have to multiply 543 times 2.4. I want to break that out. So when you're reviewing it later, you can see what I'm doing. Actual production volume of 543. 2.4 is the per unit standard quantity. So the total standard quantity, like we've done for a couple weeks here, is going to be those multiplied out. So our standard quantity is 1303. Our actual quantity, 3483. We use quite a few more cost driver units than expected. So our quantity variance is going to be, unfavorable. In that parentheses. It's just that. Okay. Actual quantity minus standard quantity times standard price. So actual quantity minus standard quantity with that in parentheses, that difference, then multiplied by standard price. So that should be our unfavorable volume overhead quantity variance. If I've copied over everything right. All right, anything you want to see? Any cells you want to see or questions about that one? No? One thing to note, real quick, you'll have it copied down, but if you're doing anything by memory, you're used to the parentheses having actual minus standard, whatever it is we're comparing. This is flipped around again because we have the static budget actually being more closer to reality than the applied cost. So we have standard quantity minus actual quantity in this one case, or the terminology that equates to standard quantity minus the terminology that equates to actual quantity. Okay, let's get one more. We wanted one of each, right? VOH price variance. We'll figure out what kind of question we can do. First, let's check to make sure. We should have 3 questions right here. Good. 9 out of 15 for the 3 questions that we answered. Let's try again, see if we can get an open answer price one. Yep. Variable overhead price variance. All right. So Palpatine climbing gear, Let's copy things over a little bit, save ourselves a little bit of time. and just edit as we need to. So now the price variance is actual price minus standard price, all multiplied by actual quantity. So we need standard price, good. We need actual quantity, good. I'll update those all these numbers. We don't need the standard quantity, so I'm going to get rid of that, and we're going to be calculating the price variance. We can know the actual price, and I'll refigure that in a second. All right, let's copy things over. 19.32, 52%. So given this sentence right here, our PDVOH is $10.05 it would round to over here. Okay, our actual quantity is 34.76, and our actual price. So I've gone the algebraic equation route, and I'm going to have to tease out the actual price from that total actual amount here. So I'm doing the opposite of what I did up here. Up here I said, I've got the actual number in total. I'm going to use that and just subtract away the other box that I'm using. I've got the full number here. I'm going to subtract away this number here. In this problem, I'm addressing it differently. I have the full here, but I'm going to go ahead and tease out the actual price so I can use the algebraic equation. I mean this one right here. So the actual price, here we'll do actual variable overhead cost, is $49,364. That's the highlighted portion on the other screen, on the other window on the screen. Okay, and we can take our actual quantity as the divisor. Is that the right word? The denominator, anyway. I know that's correct. And that'll tell us what our actual price is. Because if that's the actual cost, and this is the actual quantity, then we must have actually spent, effectively anyway, $14.20 as the actual price. Okay, so I just need to plug in those numbers following the equation. So we have parentheses actual price minus standard price, close the parentheses, all times the actual quantity. So that should be our price variance there. Okay? All right, good. No, I wanted the other one. Let's double check. I got points, good. Okay, so Chapter 8, value stream income statement and backflush costing with backflush with direct costing. All right, let's first see if we have any value stream stuff. All right, let's talk about the value stream, the conceptual questions. Which of the following best describes what value stream income statements do differently with regard to inventory? All right. Look, they all start with inventory is considered waste. So we know that's true. Inventory is considered waste. So value stream income statements highlight how much bottom line profit is affected by changes in inventory. That sounds like the adjustment at the bottom of value stream income statement to me. So maybe that's a good answer. Let's keep going. Inventory is considered waste. So value stream income statements report inventory at standard. Wait a second. That sounds like Chapter 7 stuff. Work in process is at standard, finished goods is at standard, and Chapter 8 says no. So I don't think that's right. So I don't think this one's right. We don't evaluate any inventory at standard when we're using a lean system. Inventory is considered waste, so value stream income statements highlight actual costs incurred within each value stream to bring customers from order to delivery. Now, that's technically true, but I don't think it has a bearing on inventory. It is true that value stream income statements use actual costs, but it's non sequitur with regard to the question of inventory. Doesn't doesn't directly affect it, not nearly as much as the first one. So that is a true statement. Sorry, after the comma here, it's a true statement. The value stream income statements highlight actual cost by within each value stream, but it has nothing to do with the fact that inventory is considered waste. All right, last, inventory is considered waste, so lean accounting is careful to track perpetual inventory values as products move between departments in large, cost-efficient batches. Well, if you look at the textbook, there are two problems with that one. One is we tend to use backflush costing, which is implicitly a periodic system. At the end of the period, we backflush, not a perpetual system where we're constantly updating the values of the accounts. So that part is incorrect. And then the other part is, if you read the just-in-time section, which we kind of breezed over a little bit when we went over that, it talks about how a lot of lean firms break down the manufacturing process into these little cells with cross-trained teams instead of using large, cost-efficient batches. So that part as well is inaccurate. So I don't like this one. I think this is the best answer of the four. Okay? Any more conceptual questions we can go over? Oh, wow. This one looks like it should be easy because it's so short. Income statements in a lean firm tend to organize cost information by which of the following? Department, value stream, location, or product? So value stream. I was going to say value stream income statement. What does it use? Oh, it's in the name. Right. Yeah, value stream here. Okay, good. Yeah. Thank you. Yeah. All right. Oh, well, let's see. So I've got numbers in here, but maybe they aren't very relevant. Let's see. Giftmonger Party Supplies uses value stream income statements. These statements include 3 value streams and 2 non-value streams. The first value stream is the birthday party value stream. In this value stream, the value stream income statement shows the following cost numbers: 100,000 material cost, 150,000 labor cost, and 75,000 variable overhead cost, no fixed overhead. Which of the following is most likely to be true about these cost numbers? Sorry to yell at you. I guess I was in a capital phase there instead of using bold. So first, these cost numbers are the actual dollar amounts incurred by the firm for work in the birthday party value stream. Well, that sounds like one of the tenets. We're not recording things at standard in any way. We're using actual numbers. So put a pin in that, might be the answer. These cost numbers are the actual dollar amounts incurred by the firm, except for variable overhead, which is applied to individual product units using a PDOH rate. Well, they're not going to be applying overhead. They want to separate that into value streams instead. And so here's what I'm saying. In my mind, when I say those words, they mean something. So I'm going to explain what they mean in case they're not meaning the same thing in your brain when you hear those words. What I'm saying is we have some variable overhead cost. So some cost that we can trace to the production of birthday parties in general, but they're overhead still, which means by definition, we can't trace them to individual product units. So the absorption costing traditional way of doing it is to say, well, let's develop a rate and just the average cost goes to each unit. In the lean accounting perspective, you're saying, well, we don't need to do that because we're going to leave it at the value stream level. We don't need to know the individual product unit cost for that overhead. We can trace it to the birthday party value stream. We're going to leave it there. You look at the income statements, and that's as far as those overhead costs will go. And so this isn't correct either. These cost numbers are net of quantity and price variances for direct material. Once I see the variances, I'm like, that's wrong. So no, they're not net of. We're not pulling out the quantity and price variances, which is the same thing as saying that they are at standard. That's incorrect. These cost numbers are the standard dollar amounts for the firm's work in the oh my goodness, the same. So two of the same things right here, and this one, which is incorrect because we don't need to be allocating the variable overhead directly to each individual product unit. So specifically, it's after the comma, which is incorrect in this one. All right. Oh, another conceptual question. Let's do some math. Bet you never thought you would agree to that statement before. Now you're like, yes. I don't know. Maybe that's not fair. we probably self-selected to people who are not afraid of math. If you're in an accounting class, if I were speaking to the general population, perhaps that would be true, but not true for you guys. All right, so let's look at this. We have to answer a few questions. I'm getting us prepared for next week, where we have very similar questions, but the bolded part there, direct costing, says throughput accounting instead. So with our backflush questions, we have to answer, what is the timing? We have to answer, what is a product cost? And then we can answer, what is the backflush entry? With the note that when we do it, we have to remember the raw materials entry in the RIP account. Okay, so when I have this bolded, it is an answer to the question number 2. In the direct costing paradigm, direct materials, direct labor, and variable overhead are all considered product costs, and therefore they are worth putting in inventory accounts. So we have 3 different cost categories here, but this last one, careful, it's not variable overhead, it's fixed overhead. So does direct costing consider that a product cost or not? I see shaking of heads. Good, good, good. Yes, it's not a product cost under direct costing. So that's why it's bolded here, because it's critical to interpreting the information here. All right, so these 2 are our product costs. All right, total complete and in-process units, 20,000. That's going to be our denominator. You put product costs over that total amount, and you get your rate. And ending raw materials, $0. Oh, good. We don't have to worry about that. The firm has 35 units in finished goods inventory and 25 units in work in process. Which journal entry appropriately backflushes cost inventory accounts? So if we're backflushing, it also implicitly tells us what the timing is. We're at the end of the period. Now we're backflushing costs from where? COGS. Yeah, cost of goods sold. Okay, so timing in backflush is all costs accumulated in cost of goods sold, and at the end of the period, we backflush a small amount, because we've kept inventory levels low, to our work in process and to our in process and our finished goods accounts. Put it that way. Because you notice that they have different names, like we said on Tuesday. RIP and conversion cost have replaced raw materials and WIP. All right, so we have some journal entry problems. 2 of them we can rule out right away, right? Which ones don't look like the right journal entry? 1 and 3, debit to cost of goods sold. Yeah. This can't be it. Why would we be increasing cost of goods sold when we're taking some of its cost out to put into inventory accounts? So we're not going to be debiting cost of goods sold. Cost of goods sold is an expense account. In case we forgot. So it goes up with a debit. We shouldn't be debiting it. We need to be crediting it. So it's either 2 or 4. Now, we can't use the same trick to discern between them we did on Tuesday, where I said, oh, look, there's a $50 difference between the 2, and that happens to be the amount for raw materials. Oh, I guess maybe the professor is testing me on that. Nope, there are no raw materials. Where is it? Ending raw materials is 0. Instead, what likely is happening is one of them incorporates fixed overhead erroneously, and one of them does not. That's probably what the professor is testing you on, that sneaky professor. So, let's see, we have $12 and $15. Let's just go through. Let's go through and calculate out what we're doing here. Let's calculate different parts of the entry. And we know we're older and wiser now. We know a little bit more. We can do this in a more economical fashion than before. All right, so this is our So what I want to do is I want to create some rates first. We had $4,000 of direct materials and $1,000 of direct labor. And we have $20,000, 20,000 units, which we're going to use as our denominator. Okay, so we have 20 cents as our direct materials cost per unit. That's 4,000 divided by the 20,000. And we have 5 cents as our per unit conversion cost, which is only direct labor because we don't have any variable overhead. And fixed overhead doesn't count because it's direct costing. We're in the direct costing mode. It's like we're using a dictionary. Direct costing is the dictionary we're using. In that dictionary, the only overhead that's a product cost is variable overhead. Okay, so we can take our 25 units in process and we can charge them direct material for in-process units, and we can charge them conversion costs for in-process units. And those two match. One of these looks like this one right here has RIP being debited $5, and this one and here has conversion cost being debited $1.25. And usually we would be, we also have to, go back. Remember, we have no R portion for the RIP entry. No just IP. So $5. That should be really it. Let's double check, see what the finished goods entry should be. So we have 35 units, it said. So multiply 35 by that rate. Multiply 35 by that rate. This is our DM in finished goods, our conversion cost in finished goods. So the sum of those two separate it up a little bit here. How about that? I'll do it that way. Highlight those at the end. Okay, so those should be our three debits, what we're debiting to. So we're back flushing those three amounts to three inventory accounts. And that matches number 3. Or, no, sorry, number 2. I'm not really sure in my right off the top of my head what the professor was testing with number 4. Maybe he just came up with some crazy numbers to throw us off this time. Pulled a crazy Ivan.
Negative raw materials in there.
Yep, some negative raw materials, some antimatter raw materials, yeah. Yes, that makes sense, yeah. E17, yep. I chose to keep the rates separate for direct materials and conversion costs here. And so I have to sum them because the finished goods have all they're finished. They have all that.
3 times 35 times 30.
Yep. Yeah, exactly, yeah. Okay. Yeah. Yeah. I did this just for completeness, so that we remember, because some of the problems don't have 0 in the R portion. they have some raw for raw and in process. Yeah, in case and repeat. Tuesday you weren't here or didn't catch that. We switched up the three typical raw materials, WIP, finished goods into RIP, which means raw and in process materials, and conversion costs, which just means direct labor and overhead, variable overhead specifically, that for in process units, and then finished goods. So we have RIP, CC, and finished goods, just like these three. That's a very typical setup, or an archetypal setup for the a lean firm. Yeah. Does that answer your question? Okay, let's try another one. Do I have any? Oh, I do have some open answer. Okay, these are the kind. Yeah. Okay, let's do an open answer question here. This is real quick, real simple, because it's a before question. That's going to be your clue. It's before. Probably, maybe he might be tricky. This professor, but probably this means easier, because cost of goods sold balance before is just product cost that's been accumulated. I'll articulate that word better. Nothing backflushed yet, so you don't have to worry about how much is being backflushed. And so this question here gives us three different classes of costs that we've accumulated. We have incurred, I should say. Any of these three, or which of these three, are product costs? All. That's right. All three of those. And so the cost of goods sold balance before any backflushing is the sum of these three. We did this very problem or something very similar on Tuesday. COGS before, open answer question, real simple, 14, 238, 20, 832, 10, 280, the sum of those three. Okay. All right. Sometimes I ask you about a question like this. I'm going to switch them. So I am going to be asking about the finished goods inventory balance. There are a few questions like this. But we're going to use the same principles about questions of timing and the periodicity. That sounds really long. That's like a $10 word. But the periodicity, just that it's a periodic system instead of a perpetual system. And definitions of what product costs are to do this. Okay? So finished goods has a $1,000 beginning balance. And we're going to be backflushing costs to it. So what's its balance after the fact? So basically what I'm asking is, take the backflush entry and add $1,000 to it. I don't want you to think much deeper than that. This question is a rudimentary way of asking you to figure out the backflush amount. Okay? When chapter 8 comes up, I'm already thinking of ways to change questions. So when it comes up in my workflow, which at that point you'll be in your careers and off in the wild blue yonder. Since you're so concerned, I know, about what I do with this class after you graduate, that's what I'm going to do. It's this question I've already got targeted as one I might change. But as it is right now, it's just asking you to figure out the backflush entry and then add the $1,000 beginning balance to it. Again, don't apply too much logic to it there. Lean accounting wants to be quick and easy, and small inaccuracies it considers to be irrelevant. All right, so we have direct costing, good. And so what we say is, which of these four are product costs? The first three. Thank you. All right, so we need to figure out these are the costs we're going to be using to backflush a small portion of them to the finished goods account. And we have a denominator here, total units in process, total units completed and in process, 40,000. No equivalent units. No, don't worry about that. Remember, just this number is going to be our denominator. And so what I'm going to do, because we're only worried about what goes to finished goods and they're finished, we don't have to break up direct materials and conversion costs or anything like that. I'm going to lump all three of those product costs together in the numerator and just get a total cost per unit and multiply it by the number of units in finished goods. This makes sense when I say it, right? I take total cost divided by the total completed units, get my total cost per unit, and then multiply that by the number of units in finished goods, and then add the beginning balance of finished goods inventory into it. So it's either 1 or 4, A or D here, because it's going to be over 1,000. So let's do that. Do FG balance after MCQ. So balance after question, finished goods balance after back flushing, and multiple choice question. So we have $1,000. That's our FG existing balance we're going to say. We have $100,000 direct materials cost, $40,000 direct labor cost, $80,000 of variable overhead cost. And so the sum of those, the total product cost, is 220,000. Total units, 40,000. 5.5. Total unit cost, $5.50. That's what that means. We have 160 units in finished goods. That's right from the problem right here. So we're just going to multiply those out and get $880. This is the back flush entry, the amount the back flush entry sends to finished goods. Okay, add that to the existing balance, and that is the after FG balance. That should be the answer right there. All right, so I want to point out here, I'm probably going to revise this kind of question in the future semesters, but I think it actually points out something important, and I want to point out another aspect that maybe you've keyed into and maybe you haven't, because we've got a lot going on this week. Maybe you haven't really thought too deeply about this, or you never want to think too deeply about this because you're just ready to be done with the semester. I don't know. Different strokes for different folks, right? So the logical question is that doesn't this, the way I've done it, set up continuously expanding balance of inventory accounts because you're never getting rid of the beginning balance? And the answer is yeah, it does. It does. I'm sure that if you're in a lean firm, you're going to find some way to say, well, let's do like we do with the a few other accounts on the balance sheet income statement, like the allowance for doubtful accounts, that kind of thing, and say, well, we need the net of, we need to backflush $880 to finished goods, but it already has $1,000 in it, so we probably need to decrease that amount by $220 or $120 to get to $880 as the final balance. Don't think that deeply about it. This question is really just trying to get you to do the calculations for the backflush entry. It's a clumsy way of doing it. But honestly, I wouldn't put it past a firm, a lean firm, to do it this way or to internally consider things this way, because $1,000, $880, probably a small amount. They're keeping a small amount of inventory in finished goods. They're really not too concerned about the precision of it. So they'll just have a true up maybe every couple or every 3 years or something like that. Say, well, okay, well, let's go count the actual amount and true it up to that amount. True the value up to what is actually in finished goods. The other thing that happens is if you're paying close attention to what we do with the portion in raw materials here. It's not the best question to do it. Yeah, it's the only one I have though. The only one with an actual raw materials balance is that we're going to be double counting those costs. That's the nature of what we've done. Because that $50 of raw materials in the warehouse is likely also a direct material cost we have up here. We probably bought them, I don't know how long units last in the warehouse, raw materials last in the warehouse, but we probably bought that, and it's at least a portion of that is probably included in the direct materials cost that we turned into a per unit rate already in this problem. But it's right up there. And then we're going to go charge in process units a full cost of direct materials and add in the raw portion. We've double counted those costs. But that kind of inaccuracy is one that they'll overlook because, Again, we're not worried about the precision in lean accounting mindset. The cost of precision is one we're trying to eliminate as waste, because we say that that kind of precision is going to fixate us on the inventory value amounts, and we really only care that the inventory values are low. All right, so 2 ways in which this system may grade on you as good, dutiful accountants with attention to detail. One, because I've picked a clumsy way to ask the finished goods question, and I've omitted the idea that there might be a true up at some point. A true up, funny phrase that I hear all the time, although it's very untechnical. And also another way because, well, we're double counting, but we don't really care because the values are small and the cost of making it accurate are too high for us. Okay. Well, here's what I think I will do. Because of your question. I almost said this earlier too. So I would love to get a little more time doing these questions, but I don't want us to be delaying way far. So what I want to do is I want to extend this deadline to Wednesday. In a day Wednesday. So we'll have another class time, Tuesday, where we can do some questions without 7.2 hanging over our heads, all 7-2 quizzes. So if you're feeling like, I got to rush and learn all this stuff and get good at it enough to do the quiz before end of day tomorrow, on top of 7-2 stuff that might be outstanding for you, I'll ease your mind there. We'll extend this to Wednesday, and then we have 8-2. We'll make sure we get 8-2 by Friday. So then we're done with extension stuff. We're caught up. Is that good? I think that's a good balance of things there. Okay, that said, I still want to move forward with. I still want to get the theory out for 8-2. So let's talk about the throughput accounting part just for like 5 minutes here. So we have variable costing. That's what we've been doing, direct or variable costing. And then we have this idea of 8.4 time-related waste. We have one section of 8-2, which is about the capacity waste. And we actually do get some variances. And I don't have enough time to do the full spiel on this, but we'll come back to it on Tuesday. We get some variances. So they don't care about the normal variances we did in Chapter 7. They say, no, we care about capacity variances because capacity variances reflect wasted time. We bought this factory for millions of dollars, and operating it at idleness is a waste. It's a cost. So we're going to worry about operating below capacity is the idea. So we have 5 different measures of capacity and 5 different measures. So 4 differences between measures. We end up with 4 capacity numbers. All right, we'll cover those later. The second aspect of worrying about time-related waste is the theory of constraints. And I like this topic a lot. I haven't found a way to concisely incorporate much of it into the class. So the point of it is, I just want to get some bullet point ideas out. At one point, there was a class that requires you to read the business novel. It's an odd category called The Goal. Any class that you have require you to read The Goal? Yeah? You did? For a class? Yeah. Okay, cool. Nobody else has read it? You have read it? For a class or not? For class? Anybody read it for fun? Be proud. Okay, well, it's not that bad. But it basically encapsulates the fundamentals of the theory of constraints. And so the idea is basically there is one master constraint, which is the sun, in the fact that we have 24 hours a day. That's a weird way of saying it. But the point is, every company in the world, Apple, Microsoft, mom and pop shop down the street, 24 hours a day. That's it. It's the equalizer. And so the question is, how can we do the most with the time that we have? And so what are the constraints on that? And it was developed by Elihu Goldratt, who wrote The Goal. And he says he was from a more physics and engineering background. He says, all right, well, let's develop a system that a mathematical way of explaining the production technology of a firm and figure out what the constraints are for it to maximize how much work it does in a given period of time. And really, it should be focusing on those constraints and saying, and trying to say, also a constraint could be called a bottleneck, and focusing on those bottlenecks and trying to maximize how much throughput, which is the word that's critical there, how much throughput it can get through the bottleneck, and then over time find ways to expand the bottleneck by improving technology, improving procedures, or whatnot. Basically, what it does for our purposes is it changes the backflush costing ever slightly. I said what it did already on Tuesday. Let me read what I wrote here. So as part of their analysis of the firm's constraint, theory of constraint practicing firms generally do not consider labor or overhead to be variable costs or product costs. Only raw materials are considered to truly vary with production. Sometimes the term totally variable cost or truly variable cost to refer to these costs that should be considered product costs, and it almost exclusively means raw materials. All right, so throughput accounting, a system of our accounting in which raw materials are considered variable costs or product costs. Only raw materials. Skip that word when I read it. And so what that means when we backflush is we're going to be even simpler. Remember, we went from raw materials, WIP, and finished goods to RIP, conversion costs and finished goods. What are conversion costs? What are the two things that go into conversion costs? Yep, direct labor and variable overhead. Or generally overhead, but yeah, in this case, we're talking about variable overhead. Are either of those considered product costs by throughput accounting? No. So you're not even having an account. You're just saying, well, raw and in-process materials. And our goal is to get as many of those through our constraint as possible because they're the truly variable cost, totally variable cost. And so all we have is a debit to RIP and a debit to finished goods when we backflush. One less line in the entry, one less calculation you have to do, two fewer types of costs to worry about. And so just as a preview, let's look at a question real quick. Just look at it. We won't do it. Just look at it. So we have a question, and this kind of question, which has my best firm name ever, Outcrapping, which is a sanitation firm, those porta potties. I ran that by somebody who runs a porta potty business, and he didn't think it was very funny. I don't know what's wrong with him. Anyway, this looks exactly the same as a 8-1 question. The only difference is the bolded phrase there. So this question says the firm uses throughput accounting. And so we're going to do basically the same thing that you do in 8-1, but we're going to say, wait, our dictionary has changed. Product costs are not direct materials, direct labor, and variable overhead. It's just direct materials. So you do the same things as we did in 8-1, but you're just going to say only this $14,000 is a product cost. Okay, that's really where I want to stop. We'll go over everything promised on Tuesday.